Most women have no idea they can use the same tax strategies the wealthy use to pay almost nothing in taxes. Let me say this again. It's possible for you to pay no taxes if you utilize the right strategies. But most women either don't know they exist or they find out when it's already too late. This is the Women Growing Wealth podcast, and I'm your host, Tamar Hermes. My guest today is Amanda Hahn, best-selling author, nationally recognized CPA, and trusted advisor to some of the most successful real estate investors in the country. She's also a dear friend. Amanda's been featured in Forbes, Bigger Pockets, and Bloomberg. She's here today to walk us through how business owners, high-earning professionals, and everyday investors can legally reduce their taxes and grow wealth by using the IRS code exactly as it is written. This isn't about loopholes. It's about being proactive with your taxes and knowing what most people don't. Just imagine having 25% more income without earning more at all, just by using smart tax strategies. Let's get into it. So here we go, everyone. I am here with Amanda Hahn, a dear friend and an extraordinary human and incredible CPA that everyone should know about if you don't already, although I'm sure a lot of the listeners already know who you are, Amanda. I'm going to dive right in because I want this episode to be chock full of CPA strategies, accounting ideas, and how to grow wealth. And I also want to bring in the idea that Amanda Hahn is a mom, an investor, a businesswoman. And I want to ask you, how has your personal experience in your life shaped the way that you've built wealth?
Oh my goodness, that's a big question. I think I was really fortunate in that I grew up in a family of entrepreneurs. So my grandparents were entrepreneurs, very successful in Asia. And then, my parents, my dad more specifically, was an entrepreneur as well. So I think that's really just been in my blood. When you grow up around a family of entrepreneurs, and I'm sure that's the same way in your household, Tamar, is that as a kid, I was always listening to strategies and business and, dealing with team members. So I think for me, it's a unique insight into that sort of how I was brought up. Now, on the other hand, my mom was the total opposite. You know how they say people marry opposites attract. So my mom came from a very traditional upbringing, hard worker, worked her whole life at a job. And so I do kind of see like the difference between those two. But I think for me, naturally in my blood, it's more the entrepreneurial investor side.
I love that. And I think it's so important because I have taught that and modeled that for my children as an entrepreneur and
Mhm.
investor, although my parents didn't really teach us. And I think that was another reason why it was so important for me, because when I hear stories about the way that you grew up, Amanda, and when I hear stories about other kids frequently when they're young that grow up with parents that are driving and setting a role model and showing what's possible, it really supports kids in terms of what is possible for them. So I love that you're sharing that. And it sounds like because of that, you grew up feeling comfortable around money. But how did you end up deciding to become a CPA? And then how did you pivot into growing this huge CPA firm with your husband?
Yeah, it's really interesting. So my journey to becoming a CPA is maybe not as interesting or sexy as what somebody might think. So my mom was an accountant. And growing up being a girl, she always said, you should go into accounting. And because it's a really stable job, right? Everybody needs to get their bookkeeping done. And at the time, she said accounting is a job where you could have a lot of work-life balance. You get to work in the office, you get to still hang out with your kids and take your kids everywhere. So for me, I was kind of always sort of directed towards being an accountant for those reasons. But when I actually graduated and got my degree, I didn't actually go into the accounting and bookkeeping side of things. I went into public accounting to do taxes because that was more strategy. That's the part that I was more drawn to. And, for anyone who files taxes, which is everyone, there's not a whole lot of work-life balance. We're very deadline driven, right? Deadlines of tax returns and things like that. Um, but yeah, I started out my career in a big four public accounting firm, and I happened to end up in their real estate investment group. So that's sort of why I cut my teeth doing taxes and planning for a lot of the, public real estate companies, large investment firms. And yeah, it was interestingly enough, I never wanted to invest in real estate myself. Because my grandparents did a lot of real estate investing and they were very hands-on as landlords. And in fact, I grew up living in the same condo community where my grandparents owned most of the units. So, I had to go with them to handle tenants who weren't paying rent. And it was just all the stuff I didn't want to do. But really, once I got into working on the tax side and I saw how a lot of our clients were making so much money, but barely paying any taxes, was when my husband and I started thinking, well, maybe we should do real estate investing. But I think for us, the key is how do we invest in real estate, build wealth, save taxes without being a hands-on landlord? That was going to be the key for us.
Okay, I think anyone listening is like, tell me more, music to my ears. I'm going to make money, own property, and not pay taxes. Let's go. Now, do you feel that there is a difference in the way that women and men deal with tax strategies and or come into your office?
Yeah, I mean, I don't want to say women versus men because I think but there are oftentimes different personalities when it comes to married couples. And obviously, when we do, tax returns and planning, we're dealing with, a lot of the times we're dealing with both people. And I said earlier, opposites attract, right? So it's very frequently we're talking to the person who's very, like, let's go, very aggressive. I want to build wealth. I want to do all these things. And then you have the other spouse who's a little bit more laid back, like, well, let's look at the numbers, let's think about it, discuss it. So, but I do think that's good. That's actually an asset to having a team like that because if we have both spouses just going all in, jumping in head first, sometimes we do things prematurely, right? So I don't know if that's a man versus woman, but more so we see that kind of that pairing frequently in a marriage or in a relationship, even with partners, business partners too. You got different personalities within maybe the two or three leaders.
100%. And that's such a great topic too, because actually my husband and I are going to be doing an episode on how we built wealth together after 24 years of marriage. So it is definitely an interesting thing. And I love that you say that it's kind of a yin and yang and something interesting to look at. Or sometimes when a woman comes in, I feel like with my clients, a lot of them are just like, help me. I don't understand how I can save money on taxes. And so, and obviously your specialty is real estate. And this is such a great topic for anyone listening. And it'll definitely open up so many doors and new ideas and opportunities. So why are so many people still overpaying in taxes? Like what are we missing?
I think you kind of said it earlier, it's people thinking that taxes are complicated, not really understand what could be done. I think most people, especially in the US, we kind of tend to think taxes are just something that happens to us. Because we're kind of taught that, right? Tax law favors large corporations. Middle Americans pay the most tax. So one of my passions is really in educating people that taxes are not just something that happens to us. It is something that we can plan around. The tax code is filled with strategies and incentives on what the government wants us to do. And when we do those things, then we can save on taxes and keep more of the money we make. So it's not, whether you are a large corporation or you're just a small business owner or first-time real estate investor, we're able to use the same strategies that are available to the large corporations, right? We just have a lot fewer zeros behind our numbers, but it's the same strategies and it's just about how do we pivot? How do we pivot to understand what those strategies are? and being intentional about how do we utilize it? How do we do the right things during the year so that at tax time, we can legitimately say, okay, we did all those right things. Now we can save on taxes for all the money we made last year.
I love this. Okay, we've got to dive in. I can't resist talking about taxes. It's like I geek out with Amanda, and I'll just I'm always texting her. What about this? What about that? This is so cool. This is so cool. Because yes, I figured out that as well, which is that anyone can grow wealth, and we may have less zeros, but we still can add those zeros up if we are saving in taxes. It is an exponential way to have more money to do things with in our life and to save and invest and grow our businesses and do all the things. And it's all legal. These are the incentives of the government for us to be able to grow our wealth. So let's get started. So let's talk about what are the three best tax strategies that people can utilize right now that you see are the low hanging fruit?
Well, I think there's so many. I don't know if I can just summarize it down to three, but when we look at tax planning, a couple of things we're always looking at, right, is the timing of the taxes. Those are what so the concept would be, how can I pay less taxes today? Even if it means I'm going to have to pay the same amount of tax later down the road, I'm still happy with that because saving on taxes to me today means more money for me to invest and grow and build wealth, right? So from that perspective, we're looking at things like retirement contributions. People are like, oh, IRAs, a couple $1,000s, that's not significant enough. But if you are a business owner, we talked about this all the time, right? You can have a 401k, you can have a pension plan, a cash balance plan, where you can contribute $200,000-300,000 into an account to save on taxes and also use that money to invest and have that investment be tax deferred as well. So that's kind of what I always think is a low hanging fruit, because the question we ask ourselves is, would I rather pay the IRS today, or would I rather pay towards my retirement account? Right. And when you think about that way, the answer is much easier. When we pay the IRS, the return on investment is zero. When we pay towards our retirement account, well, now we open up the world to what can we use that money to invest with, whether it's real estate or a business or crypto. Um, so I think that's something everyone should be looking at. And even if you're not a business owner, I will say that retirement account assets for most Americans is one of the largest buckets of net worth for a lot of people. But people tend to become very complacent about money in retirement accounts. When we work with clients, one of the questions we always ask is, how much money do you have in your 401k? A lot of people have no idea. It's like, well, I don't know. I think it's maybe 300,000 or a million, but I don't really know. Stock market's gone down or gone up. So I think it's really important to keep an eye on that, because that doesn't have to be just lazy money we count on when we retire, but it should be money we're looking at frequently to make sure we're putting it to its highest and best use.
I love that. I love that. And let's talk about real estate. And I know frequently one of the big questions that I get asked from clients is, I have a high income W 2. What do I do? And I know that is one of the hardest spots to be in, because the IRS sees exactly what you make, and you are obligated to pay all the taxes right away. And that could be, if you're making 500,000, you could end up with maybe 250 or 300,000. So one of the strategies that I know you share a lot, and I have talked about it also on a podcast episode, is the Airbnb idea. Can you talk about that and talk about anything that a W-2 earner can do to, besides retirement accounts, which I love what you said about the lazy 401k. That's such a great analogy. So I would love to hear what your thoughts are around that.
Yeah, I mean, for what you're talking about, is what we in the tax world call the short-term rental tax loophole. And I'll first kind of define it a little bit. Why is it called a loophole, right? Because, and the reason we call it a loophole is for people who invest in traditional real estate, which would be long-term rentals, apartments, self-storage, mobile home parks, commercial properties. Usually those are considered passive losses. So even though we're writing things off, we're creating depreciation and bonus depreciation. For most people who have a full-time job, those real estate losses are just passive, which means they don't offset taxes from your W-2 income today. They only offset taxes from future passive income. And so it's not the end of the world, it's just a timing difference. We do get to use it against future passive income, or eventually when we sell the property, we do get to use it against W-2 income, regardless of, if you're still working full time. So for most people who work full time, the only way to get around that limitation and use long-term rental losses against W-2 is if you or typically a spouse can qualify as real estate professional, right? So if you work full time, your wife is a real estate professional, then great, we can use all of the losses against W-2. But for a lot of people who are single working full time, obviously, then our rental losses are passive. And so that's where the short-term rental tax loophole comes in, because if you invest in short-term rentals, Airbnbs, verbals, basically anything where the average guest stays 7 days or less, then you can potentially use these rental losses from the short-term rentals against W-2 income, even though you're not a real estate professional, even if real estate investing is sort of just a side hustle for you. And so that's what we love about short-term rental investing, is that it could work for virtually anyone. I mean, we have clients who are teachers, CPAs, attorneys, social media influencers, athletes who use this loophole because you can kind of do real estate on the side. Of course, there are still requirements, so I can't just buy an Airbnb and automatically get the benefit. You do still have to meet what we call material participation hours. And so, those are just a couple different ways to meet it, but effectively, what we're saying is you have to be involved in the day-to-day operations of your short-term rentals. And when you meet those criteria, then we kind of free up all of the tax benefits on the short-term rentals to reduce W-2 income for tax purposes.
Yeah, I love that. And I always tell clients that the Airbnb is a great opportunity if you can tolerate that sort of business, because it can be a very high maintenance business, and it can also be pretty smooth. I'm running 8 now, and I have teams in place, and it's not that difficult anymore, but there was a learning curve. And just like with anything,
Yeah.
we're going to be learning, and that's going to be something that we're going to have to decide what, choose your hard. And so, is there anything else that you recommend for W-2 earners? Because I know that that is a huge question mark for many people, is what to do about that
Mhm.
W-2.
Yeah, I mean, obviously if you're a W-2 earner and you're single, you can always consider marrying a real estate professional, right? So if you marry someone who is in real estate that can qualify as real estate professional, it's sort of what we call the marriage hack. So if even though you're the high income earner, the other person, if they're a real estate professional, they do get to offset taxes from your income. So yeah, maybe a business idea to set up a real estate matchmaking
I
company
know, I was just
for
thinking
you,
that. That would
Tamar.
be hysterical.
Did you just write that down? I just saw you write something down.
Well, it's funny because I just actually set up one of my clients, and the
Mm,
guy that I set her up with is a real estate professional. So now I'm thinking, oh, if you get married, you're going to save a lot of money. There's your tax hack.
yeah, love it, love it. And I mean, the reality is we call it a marriage hack because there are often times where in a marriage there's one person who is the main breadwinner that makes a lot of income, and you
Mhm.
oftentimes have the spouse who is working but maybe doesn't need to, right? So maybe they're working just because they've always been working. Maybe it's just like, they don't have anything else that they're super passionate about. And this is sort of an exercise we go through with a lot of our clients in that scenario. And oftentimes it's like, hey, if you stopped working, let's say you're currently working and you get making $80,000 at your job. Well, what if you stopped working and you would save $100,000 in taxes as a result of being a real estate professional? Then that's a very impactful conversation, right? It's like, okay, am I super passionate about my $80,000 job? If not, and I'm more interested in building wealth for the family, well, maybe I stop working and I spend all of my time in heading up or leading or supporting the real estate aspect of it. So not only do I save taxes, but now the wealth building for the family has just increased exponentially, right? I'm refocusing what I'm doing.
And let's also look at businesses and
Mhm.
opportunities inside businesses, which is obviously a good problem to have. If your business is growing and you're making money, it's wonderful. And at a certain point, when you realize that you're going to have to give a substantial amount of it is due for taxes, it can be not that we don't want to pay taxes, of course, but if there are laws that are allowing us to create provisions for that, we would want to do that. So, what do you recommend for business owners?
I mean, same thing. I was just talking to a new client the other day. They have a very profitable business, and both spouses were working in the business. And I said, well, what if one of you didn't work in the business? Like, what is it going to cost you to hire someone to do? The wife was doing most of like the accounting stuff. I was like, well, what is it going to cost you for someone to run this aspect so that she can do real estate? And I think they had like $11 million of real estate. Like, well, that's a lot of tax benefit that's been trapped that, we can now use all these real estate strategies to offset. Another really great one with respect to just sort of bridging the business owner and real estate world, is for business owners who, have physical footprint. Does it make sense to buy your own building to operate your business out of? Because otherwise we're just paying rent, right? We're paying rent to the property owner. And so if we have our own building, now we're paying down our debt and we're building our own portfolio of properties. But also a really amazing tax strategy associated that not a lot of people know is if I have a property where my business is utilizing, I am the tenant, right? Like a self-rental, oftentimes you can make tax elections so that you can use the real estate tax benefits to offset taxes from the business income. And this is true even if, the building is in a different LLC than what the business is operating. So that's something that that's a strategy that's been really impactful for a lot of our clients who have businesses, but also, own the real estate where their business operates out of, like a doctor who owns their medical building, right? That's a really
So
big one.
let's say I love this, and this is something that I talk about with clients as well. So let's say I am a medical professional and I am renting out an office space. So I go and I find a building that I build out, and obviously then the build out can either be deducted by my medical practice or by the business by the office building, depend on the terms negotiated, because it's almost like you have two businesses, right? That
Yep.
are
Yep.
talking to each other. You just happen to own them. And then talk to
Mhm.
me about how you were saying they can even go further with it. There was something that you had said that I would love a real world example on that.
Yeah, so I have a, medical practice, let's say I make $2 million a year. I own this building that my medical practice is going to reside in, right? So typically the structures, I have an LLC that owns my building. Maybe I have a corporation that operates my medical business. And so what will happen is I will rent from my building LLC. And when I do that, I'm basically trying to shift income from the active side, right? Active income from my medical practice over to rental income where I don't have to pay payroll or self-employment taxes on. So that's one layer of savings. I'm just creating lower tax income. And then separately, because if I occupy 100% of that medical building, I can make a grouping election, which tells the IRS that I'm effectively grouping the real estate building and my medical practice as one activity for tax purposes. So in that scenario, if my building has a tax loss from cost segregation, bonus depreciation, I can use it to offset my business income, even though they're in different entities. And this is true regardless of whether I'm a real estate professional or not. So this is where like it works really well for, someone maybe like a married couple who are both doctors, right? Because neither of them are going to be a real estate professional, but the medical building itself is something that you can use against the medical income because it's a self rental. I'm renting from myself, basically.
That's great. The grouping was something new to me. I didn't realize that you
Mhm.
could group it, and then somehow then does it become that the medical practice actually becomes part of the election of the real estate professional status, because it sounds like you can then you can then take that and marry them.
Mhm. Yeah, it's similar. So in this context, yes, you're grouping the medical practice with the medical building. So that's what's allowing the losses to offset the income. But it's not grouping real estate professional. So this works in this context is somebody who does not need to qualify as real estate professional, right? Because it's a self-rental. So it's a different strategy than real estate professional. In a normal
Right.
scenario, if I have a building and I'm renting it to you, I have to be a real estate professional to use the losses against my different income. But in this context, it has nothing to do with real estate professional. It's just a self-rental of a property associated with my business.
Right. And then you're able to get all those deductions. That's huge. That is
Mhm.
amazing. The other thing that I always tell a lot of my high income W 2 earners is to get some sort of side hustle to buy the Airbnb or do some sort of business, because then all of a sudden they have income that they can mitigate some of the advantages on. What would you
Yeah.
say about that?
Yeah, for sure. I mean, for people who are high income earners, I know a lot of CPAs. I mean, yes, so, we talked about short-term rental loophole, right? That's a great one to offset W-2 income. We talk about retirement contributions. There's charitable planning. There's different types of investments that you and I've talked about before, right? With
Mhm.
respect to oil and gas and just other more unique investments to offset income. But I also think, though, that if we talk about just traditional investing, and a lot of CPAs tell clients, like, well, you shouldn't invest in real estate because you don't get any tax benefits because you make too much money. It's a common thing I hear all the time. And what's really interesting about that statement is that it's actually wrong. When a CPA says you don't get any benefit from real estate because you make too much money and you work full time, they're just taking a tunnel vision overview at rentals not offsetting W-2 today. But as I said earlier, even if you're not a real estate professional, you have long-term rentals, all those losses don't expire. You accumulate them and they offset taxes from future passive income or future W-2 income in the year you sell the properties. So there's always a benefit to investing in real estate. It's just a matter of when you see the benefit. And I also always argue with CPAs like, hey, if John Smith here, he made $1 million at his job and he was paying 50% in taxes between federal and state. He made $30,000 of rental income, of which he paid no taxes on because of write-offs and depreciation. I mean, I think we all agree he saved taxes, right? He made more money without paying more taxes. That's absolutely immediate tax savings too. So,
I love that. Let's dive into something that people don't talk about as much, which is the charitable planning. I know it gets a little sophisticated, but I love the idea, once you start making a certain amount of money, that there are opportunities to save money on taxes and to make an imprint and give money to charity. So, can you talk about that?
yeah, and I think, a lot of for charitable planning, the thing is that, people tend to think, well, that's just basically me giving money away and taking a write-off for it. But when you look at some of the more advanced tax planning, it's not just about giving money away. Sometimes the numbers work out where you're saving more in taxes than the money you're actually giving away. But when we talk to clients about charitable planning, though, the intent, we always have to have charitable intent. Because I know there are some CPAs that, oh, we're going to say we're going to do this and that, and we're not actually going to do it. So I don't really subscribe to those types of planning. So for me, we start with the charitable intent, which is what are the causes or organizations that tugs at your heartstring, right? That you really want to help to move forward. So from a planning perspective, a couple different things. We often have clients who have sort of these anomaly years, especially in the W-2 world, where it's like, wow, this year I had some RSUs or stock options that's vesting. My income went from 200,000 to $1 million, right? Unexpectedly. So in those anomaly, or even when somebody sells a business or sells a rental property that they didn't plan for. So one of the concepts is a donor advised fund, right? I know I want to donate $200,000 to charity, but maybe today I don't really know exactly who I want to donate to just yet, or I'm not ready to give it to the charity. You can always form a donor advised fund, and these are pretty simple. You can form them with your financial advisor. And what after you form it, you basically move your assets or your investments into the donor advised fund. And with that movement is what allows you to take an immediate upfront tax deduction. And then once the money is in that fund, then in the future over time, you can then start to give those donations to church or the temple, different charities of your choice. So that's sort of a good one that we start with for clients who are like, oh, I want to donate a good amount of money. And then we get into more advanced, donations of like, hey, I want to donate the cash flow from my rental property over the next 10 years. And in exchange for that, that pledge, maybe I'm going to donate immediately the present value of all those future donations. So that's a really fun one that we work with clients on a lot, because not only am I able to take a deduction today for future donations, but I also get the real estate back at the end of the trust term. So for a lot of real estate investors, it's sort of like, well, I would love to donate cash to the charity, in the coming years, but I don't want to lose the real estate. So people like that because the real estate comes back to them. And then also, we still retain the benefits of being a real estate investor, things like write-offs and depreciation too. So that's a really good one for people who are wanting to donate a more significant dollar amount.
Amazing. So you can actually take a property, designate it, and donate all the cash flow for 10 years. And then after that, you can take the property back. And then do you start getting the cash flow back too? Or it depends
Yeah,
on how the
yep.
terms are. Wow. And is it
Yeah,
a
and
10-year
it's
term generally? Is that how it works?
no, no, I was gonna say it's super flexible in terms of how you set it up. I just use 10 years as an example, but for planning, we kind of try to work backwards. So what is the amount of donation deduction you're looking for today, right? What is the cash flow of the property every year? And then back into, okay, how many years should it be in the trust to get to that current donation that deduction that we're looking for. So super flexible.
Yeah, that's amazing. So it's basically a dollar for dollar. Like, let's say I have a property and it's making 5,000 a month. So I'm donating 50,000 a year to a charity, and then I get to deduct 50,000 a year for 10 years. And then
Mhm.
do I still get to deduct the property, all the property expenses?
Yeah, yes, because you're still paying for it. So it's a discounted present value calculation because we're actually deducting the net present value of 10 years of donations today.
Right,
So it's
right.
pretty significant. It's kind of like, well, I'm only out of pocket for 50,000 this year of cash donations, but my write-off might be 500,000, right? If I'm calculating the net present value of the
Oh,
future
wow.
donations, I'm taking it
That's
today.
huge. Call Amanda right away, like right now. That's great. I mean, this is even these I mean, this is so fun, and we love to get in the nitty-gritty with all of this because what we really Amanda and I are both so passionate about, not only women, but anyone listening, that they can grow wealth really easily by learning how to preserve the dollars they work so hard to create. And so many people are just giving it away without realizing that there's options. And in this case, you're actually giving money to a charity that you really feel passionate about. Now, how do you feel
Yeah.
about you've got two boys and they're young, and
Hmm.
you're in the
Hmm.
trenches of raising them, and
Hmm.
if you go on social media, you see her at many baseball games. She's that mom, um, and running around. So, what do you think in terms of how to set your kids up for financial success, and how and what strategies do you utilize in terms of taxes for the kids?
I mean, for me, so I have a 13-year-old, soon to be 14, going on 21.
Of course.
Um, so my 14-year-old, we use income shifting with him because, he's old enough, he's able to help out quite a bit. We have him, we had to rewire our office about a year and a half ago. And, he was here like throwing things up in the ceiling, running it between the offices. It was hard work, and it was so interesting because um, after that, I don't know what we paid him, like $15 an hour or something. And after that, a couple days of hard work. He had all the money, and I was asking him like, "What are you gonna buy?" Because he's always asking me like money for video games and all the stuff. I was like, "Well, what video games are you gonna buy?" And he was like, "Well, I have to really think about it. I wanna make sure I buy something that I really, really like." And he was never like that before. So I think just having your kids involved in your business and your real estate is so tremendous. Just to teach them what does it take to make money? $15 is not easy to make. And from a tax perspective, it's we talk with clients about this a lot too, is to like extent that they could do stuff for your real estate or for your business, then you pay them a reasonable compensation, which then becomes a tax write-off for you or your business. And depending on how much money they make, it could also be free from income taxes to them as well if they're under the standard deduction amount. So yeah, I mean, my 6-year-old doesn't do much of anything just yet. But as they grow older, the older the kids are, the more capabilities they have. And so typically that means you can pay them higher salary or 1099, right, for the work that they're actually doing.
Right. And that's what you call when you call the income shifting, you're basically saying that you're paying your children for work that they're doing legitimately inside of the company. And then that enables them, there's a certain amount, I believe it's like 15,000 now. If it's reasonable and they're actually doing the work,
Mhm.
then they're not paying taxes on it. And it's shifting the income from your high tax bracket to theirs if they're doing the work.
Yeah, and I always get questions about like, how should I pay them? How frequently should I pay them? What kind of stuff do I need to document, or do I really need to pay them? And I feel like the easiest way to answer all of those questions is you would do it in the same manner as how you would pay somebody who is unrelated to you, right? So if I hired John Smith here, how would I pay them? How frequently? How much? How would I document? And so the answer to those questions are the same exact way you would pay your kids. Because, when we pay our kids, you always want to make sure you have the right documentations. Because you can imagine if, someone's audited, an auditor is likely going to argue, well, that's just your kids. Do they really do anything? So we want to really be on top of documentation. And that's why I always tell people it's looking at how you would do all of these things with an unrelated party. So if I hired John, am I going to pay him once at December? I mean, probably not, right? He wants to be paid as he does the work. And that's sort of how we want to document payments to our kids as well. But it's just funny you said income shifting. So I know we always talk to people about income shifting, and traditionally we talk about income shifting to kids. But if you think about all the stuff that we talked about already today, it's really how do you save taxes? We shift income, right, to kids, to legal entities, to retirement, to charity, to investments, to expanding my business. It's really just saying, okay, here are all of my income. What are the different places I'm shifting it so that I'm paying less taxes at the end of the year?
I love that. I love that. And what about educating your kids in terms of understanding money, and obviously they're growing up very comfortably, and how do you teach them about their capacity? Obviously one element is having them work in the business and understanding, hey, it's not that easy to make $15 an hour. My son actually is doing a paid internship full time this summer, so with a real estate investor in Austin, and he's has a great attitude about it, which makes me feel very blessed, because you want to have your kids be eager to learn and work and participate in the world. So I'm wondering what
Yeah.
you're doing, and I know that will be helpful for a lot of my listeners that have kids that are wondering, okay, I want to make sure I'm doing the best for my kids to train them to understand how to be in the world and how to understand what they're capable of.
Yeah, I mean, I think it's just teaching them just some of the basic things. So my 13-year-old, he started becoming a kid baseball umpire a couple years ago. And so to be an umpire, you have to buy like, tools. I don't know what they're called, but clickers and special pants and shirts. And so what we did, we said, okay, well, we're going to buy these things for you, right? You need them to work, but you have to pay us back with the money you make, right? So it's kind of like a business owner, right? I need tools to do my business. Someone's gonna lend me the money, but I gotta pay it back. And as a kid umpire, I think he was getting paid like, I'm not sure, maybe like $50 per game, which is like, crazy. And so I was trying to educate him like, hey, this is the reason you're paid this amount of money is because you know baseball and you spent countless years learning the craft and the game, so now you can be an umpire, versus someone who, does not have these skill sets. They're probably working at the snack shack for $10, $15 an hour. And so just like taking opportunities to educate them on why it's important to have a skill set, and that the skill set you bring is the difference between how much you get paid, kind of like what your worth is in terms of, income generation. And of course, I'm always trying to tell him like about, creating business and business ideas and, things like that. But it's funny, I was talking with a client of mine and I was sharing like, for my 13-year-old, he's very entrepreneurial, but for some reason his business ideas are often borderline illegal. Yeah. Like, can we really do this? I don't think it's a good idea. Yeah.
Okay, let's hear one or two. This just sounds too good.
I mean, so in China a couple years ago, it came out. I was telling my kids, in China a couple years ago, it came out that the government said kids under certain age can only play video games 3 hours a week. And so my older one, his first reaction was, "Great, I'm going to get into the business of importing video game consoles to China. We're going to unlock those." I'm like, I mean, is that what you really want to do? I don't know if Chinese people can come and arrest you in the US. So, yeah, just an example of like, I like the concept, but borderline illegal.
I love the creativity though, and his ability to see opportunities. And really, what a great training for a 13-year-old to be able to think that way. And I think that we come into the world as younger people with a lot of wonder and curiosity. And then as we get shoveled through, it becomes like you have to do this, you have to do that, sit down, stand up, go to school, do this, do this. And I think that our minds get shut off from that wonder. And then we have to work
Mhm.
hard as entrepreneurs and investors to unlock that and realize, wait, this is what I really love. This is the juice of life. I want to come up with ideas, the ones that are legal, maybe I'll even pursue. So
Oh,
I
yeah,
love
and
I love the idea, and I love the opportunity for anyone that's listening to think of all these strategies and think, okay, where can I do some shifting, some change shifting here to create more income for myself? What last words would you give anyone listening? Obviously this is Women Growing Wealth, so we have a lot of women listening, but I know that there's some men in there that know how great my podcast is and listen. So what would be one move that you think, that would be the first thing that you would do if you listen to this podcast and you're on fire and you're thinking, oh my gosh, I can do this, I can do that. You have a list of notes. Where do you
mm,
want to start?
gosh, well, I mean, I'll talk specifically about taxes because I know we covered so many different things. I think just, really getting an understanding and the confidence, right? That taxes does not have to be super hard, that there are things you can do to save on taxes. I'm not saying you'll pay zero taxes this year, right? But with proper planning, for everyone who's listening, you are able to control how much taxes you pay in the long run and maybe generationally as well. And, having the confidence to know that you can do it, and that tax savings, it happens when you have the right team of advisors. That you don't have to become a CPA. You don't have to do depreciation calculations and know all of the rules and the limitations. You really just need to know, what are the things I should be doing, as a business owner, a real estate investor, or in my job. What are the things I should be doing? When should I call my CPA to be able to take advantage of these tax incentives?
I love that. And the one word that you said that I really want to touch on, because I think that it's probably the biggest place where people miss tax opportunities, is the planning. So let's talk
Mhm.
about planning here. And I want everybody to really be listening, because I feel like even this happens to me. I'm busy in my business, I'm busy with investing or whatever I'm doing. And then all of a sudden the years going by, and planning needs to happen at a certain cadence throughout the year. So can you talk about that and what's ideal and what you're looking for at each stage?
Yeah, I mean tax planning. So t people tend to think tax planning, like you save taxes when you file your return, right? So a lot of people come to me like, oh, I made so much money last year. Can you file my tax returns? Always tell people, I mean, whether I file your return or somebody else does it for last year, there's not a whole lot of difference because the year's already over, right? So, but tax planning is something that happens during the year, before you enter into transactions. So, if we're talking about real estate, it's before you buy a property, before you partner with someone, before you sell a property, before you refinance, before you move your real estate. And the same thing for businesses, right? Before I expand, before I hire people, before I bring on partners. It's because it's before those specific transactions when your tax advisor can help guide you on what is the best way for us to do that. Is it a different entity? Is it a different contract? Is it a different location for a property? And so, again, as a taxpayer, your sole job is to make sure you have the right advisor and that you have an open line of communication with them to keep them updated on here's what I'm thinking. What are your thoughts about that? What kind of strategies do you have for me? And so, it's really just an open dialogue. And you're right, we have a lot of clients too who, as much as we train them, they sort of forget about us sometimes because they're so busy building their business. So one of the things I do is I stalk people on social media. I'm on Instagram all the time. I stalk my clients and I find some crazy things. People like showing stuff about their property. I'm like, what property is that? You're doing ground up construction? Which entity are we in here? Um, and so it's just keeping, just kind of reminding yourself, like something's going on. I'm just going to shoot off a quick email to my CPA and say, hey, I'm, doing something or I'm partnering with this person. Like, what should I think about? Right? As simple as that.
That's so great. That's so important. And really, do you recommend quarterly meetings or at least in September, October, getting into Q4, you really want to be looking at what transpired that year? I know I have many clients and friends that have done exits and they properly will plan a couple of years in advance
Yeah.
for that exit and tax
Yeah.
strategy and ideas so they don't get stuck.
Yeah, we do exit planning. Yeah, I mean, ideally, it's typically 3 years in advance for an exit of a business. I just had a call with a client yesterday or 2 days ago, who has a lot of syndications, and we're doing exit planning 4 or 5 years in advance because they're large amounts, right? So, like, what are all the things we could be doing now or thinking about? The larger the potential tax gain or transaction, the sooner, the further out you want to be able to plan for, because we never want to be stuck at the end of a year with a bunch of income or gain in cash and have to hurry to try to reinvest and throw it at different investments, which may not be as ideal. But yes, year-end planning is a huge one. Typically, we start early October, goes through preferably early December, sometimes late December, because that's sort of the catch-all. What did you do? What didn't you do? What are some of the things we could still do? We actually, for our clients, we don't have quarterlies because every client is different. There are clients we talk to like once a week. Sometimes we talk to a client multiple times a week, just depending on what's going on with them. And then sometimes we talk to them twice a year, right? So again, for it just differs depending on what you have going on. And it's just kind of really reminding yourself when I'm doing something, does this have a financial impact? Should I at least shoot my CPA a quick email just to let them know what's going on?
That's great. I love that. And one other thing that came up for me when you were talking about planning is that you were saying that once I come to you in November and I say, "Oh, hey, I did all this stuff," and it's just the year end, and you're scrambling around, and it just a lot of it's too late. One of the things also that comes up that people don't realize is that you can amend tax returns. So if, let's say, in the past few years there were certain things where you weren't taking deductions, you can go back 3 years. And tell me about that, because I know oftentimes whenever I start with a new CPA, which has happened a couple of times in my life, probably not alone, there's always something that they catch where they say, "Oh, I can amend your return from last year."
Yeah, it's interesting because when we do tax planning with clients, one of the first things we do is review previous year's tax return. So we want to look at personal, we want to look at business. And I think roughly about 40% of tax returns we review are not optimized for tax savings, and sometimes they're major things sometimes they're smaller things. And so part of the art is to try to help the client understand whether it makes sense to amend as well, right? Because whenever you amend a tax return, there's often higher risk associated with being audited, especially if you're doing so to claim large refunds. IRS wants to know what changed, right? What's going on here? And so what I always tell people is like, if we can do it right the first time, that's always better. When we have to amend, then we take all of these different aspects into consideration. What are we amending for? What's the cost? And also not everything could be amended. There are things in the tax world, believe it or not, where you have to do it right the first time, then you can't really change it thereafter. But yes, that's always a good starting point, right? Because for me, when I look at a return, and it's always so fun for me to look at tax returns, because you just learn so much about about somebody. Um, but it is to kind of get an idea also on what is the exposure. Sometimes people do things that they're not supposed to. And as a taxpayer, I want to know. I ask clients a lot, like, oh, what is this amount that you wrote off? And they're like, I don't know. I have no idea. I think my CPA just like put random things on there. And I know some people are like, okay, great. My CPA is like, aggressive. Whereas a lot of people are like, no, that's not okay. I didn't know they were doing those kinds of things, right? So we try to help people from both directions.
Exactly. Yeah. And that open and communication is so important. And I would love for you to let the listeners know where they can get in touch with you. And I know that you have the capability to take on clients for tax planning. So that is something that I'm sure a lot of listeners will be interested in.
So my firm is called Keystone CPA. We're the one in California. There's another one in Reno by the same name. So make sure you go to the right one. On our website, we have a tax risk assessment, and it's basically a self-assessment that you can take. Because a lot of people ask us, like, how do I know if I'm overpaying in taxes? And the reality is, I don't know if you're overpaying in taxes, but we've created a series of important questions for the audience to take. And so you go through a set of questions about your personal, your business, your real estate, your retirement, and then you're emailed a score at the end of the assessment, and then you can see how you're doing. If you scored high, then that's amazing. That means you've covered a lot of the foundational areas that people typically miss. And if you score low, that's also okay, because you can then use the results as a roadmap to, if you're meeting with your CPA, you can say, hey, here, I took a little assessment. Let's start with these areas where I wasn't able to say yes to, and look at what are all the different opportunities. Right? And if your CPA, of course, if they don't do planning, you can reach out to us as well. KeystoneCPA.com. I'm always on Instagram every day. Instagram, YouTube, LinkedIn, Facebook as Amanda Han CPA.
Awesome. I love that. And yes, the tax planning is something that you can use in conjunction with your CPA. So, which is often great. You can bring ideas and collaborate and learn more about strategies that maybe your CPA doesn't know, because not everyone is as well versed in real estate and certain strategies that Keystone has come up with and utilizing effectively. So thank
Yeah.
you, Amanda, so much for being on Women Growing Wealth. And listeners, please hit like and subscribe if you're on YouTube, or ping me a like and comment wherever you're listening to this podcast. Thank you.
Thanks, Tamar.